Balance of trade is like the current account, same as current account. Okay, current account, what do? We do business. In current account, we do the business. Similarly, in balance of trade, we do the business. Balance of payment means what? It's a remaining thing other than business. Okay. So if any NRI is transferring the funds, some FDI coming to India, these all say this NRI, FPI, NRI, FDI, all the ECB, external commercial borrowings, all these terms are in BOP. Whereas in BOT, it's only business, pure. Give something, take something. That's the basic logic. So, and one more important part, the current account, the March 31st balance of the current account or the net profit of current account is always transferred to the savings account, isn't it? In your business also, normally if even I do the business, what will I do? I'll do the business up to March 31st, and on March 31st, whatever is my net profit, that will be transferred from business to my savings account, isn't it? Same logic is happening over here. The March 31st business or profit of BOT is always transferred to BOP. That's why remember one basic logic. BOT is a sub part of BOP. BOP is a main, and after that, within that, it comes BOT. Okay. So net of balance of trade will always be transferred to balance of payment. Okay. Now one more part. Rupee is fully convertible in this BOT, balance of trade, and in balance of payment it is partially convertible. Remember this by heart. Rupee is fully convertible in balance of trade, and in balance of payment it is partially convertible. Means what? What do you mean by this convertibility? It means that suppose if I get an order or if I get an export order, okay, or import order, let's say I take an import order, okay, for 100 crore USD, for 100 crore USD, if I take an import order, now everything is okay, going on well. If I have documents, then nobody can question me. Why am I transferring this much amount? As far as I have the legal documents, all the documents if I am having, then nobody can question me. That's called as fully convertibility. No questions asked except these KYC AML questions. Okay. But in balance of payment, it's not the case. Suppose if I say I want to transfer 10 lakh USD tomorrow to my friend in USA, RBI will immediately question me. Why am I transferring? What is the reason? Am I allowed to do so under LRS? All these schemes will come in picture. Okay. So that's why remember BOT and BOP, the two separate things are rupees fully convertible in balance of trade and rupees partially convertible in balance of payment. Now balance of payment is the ultimate thing. Okay. So generally surplus leads to stronger currency while deficit weakens the currency. Economic growth rate means basically we'll talk of GDP over here. Higher growth rate leads to a rise in imports and fall in the value of the currency and vice versa. Means here, this is a short-term perspective. From longer-term perspective, this higher growth rate will lead to rise in exports in the longer term. Let me write it over here. Will lead to rise in exports actually over here. Because in short term, it will lead to capital goods over here. Okay. So short term, it is better. But in long term, it will lead to rise in exports over here. Now, exports, so if they rise, then the currency will also fall or rise. It depends on the situation, market situation. But in the long run, always remember, if the exports are increasing, then the country becomes stronger. Their currency becomes stronger. Okay. Now, next one, fiscal policy. An expansionary policy, lower taxes can lead to higher economic growth. Now, remember, fiscal policy and monetary policy, these two policies, fiscal is always given by the finance ministry and monetary policy is always given by RBI. So fiscal, hi Sushma, hi everyone, those who have joined from the earlier batches, so need not, it is the same, similar for them, but we are moving fast now. And those who are new, kindly pay focused attention. Okay. Now in monetary policy, remember, fiscal is always given by the finance ministry and monetary is given by RBI. But remember one important point. RBI cannot exist without the government. Keep it very simple. RBI cannot exist without the government. So RBI's monetary policy will always be supportive to the fiscal policy. Important. See this. Fiscal and monetary. Okay. Fiscal is given by government, RBI, monetary is given by RBI. Okay. Now, in expansionary fiscal policy, what does the government do? Now, look at this. Pay attention, everyone. In fiscal policy, if they want to move to expansionary policy, expanding the economy, what will they do? They will decrease the taxes, increase the rebates. Decrease the taxes, increase the rebates, right? In expansionary. Whereas what will RBI do? If RBI wants to go for the expansionary policy, it will decrease that repo rate and CRR rate. It will decrease that repo and CRR. So whenever it decreases repo and CRR, it leads to higher growth in GDP. But it again leads to inflation also. So this is positive aspect for the economy, but this is negative aspect for the economy. If inflation rises, always people will be fed up of the government. Okay. Presently, see this in USA. USA, they are having the same problem now. They were going on increasing the interest rates. Now they have stopped. So because of increasing the interest rates, what has happened? Their GDP has gone down. They had gone for the contractionary policy. So their GDP had gone down over here. GDP gone down and inflation also gone down. But all the banks failures, two to three banks failed, SVB Bank and what was that? Credit Suisse Bank. Both these banks failed. Why? Because of this increase in the interest rates. Their bonds of those banks were of no value because government itself was giving higher rate of interest. So that's why everyone bought the government bonds and their bonds had no value. So that's why remember, whenever RBI goes for the expansionary policy, it will reduce these two rates, repo and CRR. These are the two main tools in the hands of RBI. And always remember, this RBI's policy will always support government's policy. If they are in expansion and RBI can't go in contraction. If they are in contraction, RBI will also have to go in contraction. Means whatever. It will always support the government. It can't go against the government's policy. Okay. This is long term always and this is temporary. RBI's monetary policy comes every 2 months. But government's fiscal policy, it doesn't come every 2 months. Okay. Now, interest rates. Higher domestic interest rates tend to attract overseas capital. Thus, currency appreciates in the short term. In longer term, however, the interest rates slow the economy, slow down. Okay. So balance of payment. See here, factors determining the exchange rates. Now, exchange rates means what? Basically, these are two or more currencies when we deal in. Two or more means what? Either dollar, rupee, or the third currency, pound, or Japanese yen, anything. Okay. Yeah. Till interest rate, we had done it. Okay. Till interest rates, we had done it. This part, we had done it. Okay. So, let's move on from here. Political issues. So pestle analysis is an important analysis. Pestle means what? Political, economic, social, technological, environmental, and legal. This analysis will help you. Yeah. This analysis will help any investor to invest in any country. Okay. So political stability is likely to lead the economic stability. Now, important part is, suppose I gave you the example of, suppose if I tell you to invest in Afghanistan, there is a good opportunity. Okay. But will you invest? No. Why? Because political stability. If I tell you to invest in North Korea, you won't invest. Why? Because you know there is no stability in that country, and anytime this government can interfere in between and kick you out of the country. Okay. So that's why political issues are very important over here. Now, those who are on watching on YouTube, kindly download Adda 24/7 app on your mobile. In this app, you'll be getting all the premium study materials plus live classes, ebooks, tests, everything. Okay, so download it immediately. Technical reasons. These are the short-term reasons. Short-term means what? Generally 3 months. Okay, 3 months reasons. This generally affects for 3 months only. So what are those? One is government controls. Government controls means how much the government interferes in those currencies. Whereas in India, government doesn't interfere at all directly. Indirectly it can, but directly it doesn't. Okay. Freedom of government controls can lead to unrealistic value of the currency, resulting in the violent exchange rates. So if government interferes in between, this generally happens in the least developed countries. Means, for example, Pakistan, Sri Lanka, government immediately interferes over there. In developed also, China government controls are a lot. They totally control their currency. Okay. So, second one, capital tends to move from lower yielding to higher yielding. Same thing has happened in US presently. What has happened in USA? USA, they have increased the rates, okay, of the bonds. So if they have increased the rates of the bonds, what happens? All the investors throughout the world will see that the rates of the bond rates are going high. So it means the prices are going down. So here, always remember, bond rates rate, or I'll call it interest rate and the price of the bond will always be in opposite direction. If interest rate is higher, this price of the bond will go lower, price will go down. Okay, so they are always in opposite direction. So in USA, what was happening since almost June last year to December, even January, February, what was happening was the government was going on increasing the interest rates. Because of that, what happened? The prices of the bonds fell down. And because of that, what happened? Everyone in the world tried to invest in US for lower prices. Okay. Speculative forces can have major effect on exchange rates. In an expectation that the currency will be devalued, the speculator will short sell the currency for buying it back at the later rate. So what do you mean by this short selling? Short selling means, look at this. Long position and short. We are having two positions over here. Long means what? I'll buy now and sell later. Means, for example, if I'm planning to buy gold, okay. So if I expect the gold rates, so for example, let me take a recent example only. In December 2022, December means what? Just 6 months back, the rate of gold was around 53,000 for 10 grams. Around 53,000 for 10 grams. What is the rate today? The rate today is around 62,000, isn't it? 62 approximately. Now from 53 to 62 within 6 months. So how much percentage does it become? 53 to 62 means roughly it becomes what? 7, 8, 14%, 14 roughly on an average, 14 to 15%. Okay. So even if I consider this 13% also, It is more than the FD rate which I'm getting. Okay. So that's why what happens whenever I'm expecting the market to go up, I always go in a long position. Means I buy now and sell later. And reverse is the case with other things. Reverse case means if I expect the market to go down, what will happen? I'll sell now and then buy later. Okay, means for example, now only gold is at its peak around 62,000 approximately. So if the gold rate is around 62,000 and I expect that the gold should go down to 58,000. So what will I do? I'll short sell it. Short sell means what? I'll sell now all the gold which I'm not having. See here in short selling position, remember one part. I am not having the commodity. I am selling it first only without having it. And then whenever it goes down, I'll buy later. Okay. So this is the riskiest position in short selling, but this happens in treasury as well as in commodities. In an expectation that the currency will be devalued or it will go down, the speculator will short sell the currency to buy it later at a cheaper rate, right? Now fill in the blanks. The term foreign exchange is used to denote dash as well as the dash of one currency into another. So I've given the answers over here. See here, those who are in the paid batch, you'll immediately see on the next page in the PDF which I've shared. Okay. So foreign exchange is used to denote what? Denote dash. Foreign currency as well as the exchange of one currency into another. So both the terms mean foreign exchange. That currency also and exchange also. Okay. The exchange rates of major currencies fluctuate every 4 seconds. Now this is another one. See this, 4 seconds. Now true or false? Now this is just a revision we are taking for time being. Okay. The forex markets are dynamic and round the clock markets. True or false? So dynamic, true or false? It's true, right? Whenever we sleep in India, US is working. Then similarly Europe has a different timing. So it's a 24-hour market. And all the markets have the effect on all the markets. That's the basic logic. Forex markets are not affected by government policies. That is wrong. Forex markets will always be affected by the government policies. A large part of the total global forex turnover results from global commodities trade. So is it so? No. Commodities trade is not a major part in the world. Major trade in forex turnover is the treasury operations, treasury and transfer of money. Huge business. So this is false answer. Okay. So this I have given the answers over here. True, false, and false. Okay. Most of the forex deals are done on spot basis. Now spot means what? In JAIIB we have studied this. Cash ready, TOM, spot, forward, and future. Right? What is cash ready? It is on the same day, T plus 0, right? Say this, T plus 0, same day. TOM means what? Tomorrow. Tomorrow means what? Next working day. Remember, next working day, not next day, next working day, T plus 1. Spot means what? Next to next working day, T plus 2. Forward means what? Any day after spot, means greater than T plus 2. Future means what? Here, one thing I'll tell you. Future and forward, they are same. There is no difference between future and forward except what is future? Future is organized forward. Now what do you mean by organized forward? Say this. Let's take one example over here. Suppose if I want to sell a dollar to somebody, I am the bank and there is a customer of mine. So I want to sell the dollars to that customer. So how many parties are involved? Only 2 parties. One is buyer, one is seller. Means bank and a customer. Only 2 parties. There is no third party involved over here. Right? What do we do in loans? Loans also, it's a 2-party system. I give the loan, somebody takes it. Now what is future? Future is a extension of these two parties. There are 3 parties involved. Now, which are those 3 parties? One is buyer, second is seller, and third party is exchange. Now, what is exchange? Exchange is like the broker. We do this plot purchases and sales or flat purchasing in major metro cities. We always go through these brokers, right? What do these brokers do? These brokers always check the financial details, means the document details of the property, right? So these documents, details of the property are checked by these brokers. Similarly, this means basically what are they doing? They are covering the settlement risk. Settlement risk means if buyer buys that property, the document should be delivered to that buyer. And seller, if the seller sells that property, money should be delivered to that seller. So that is known as settlement risk. So future is meant by organized forward. Means there is the exchange or the broker in between. Like in NSE BSE, whenever you buy or sell the shares, you never come to know who the seller is. Suppose if you buy, you never come to know who the seller is. Or if you sell, you never come to know who the buyer is. So that's why this future market is a organized forward. There is a third party who controls everything. Okay. Yeah. So future done this. Yeah. Now what is the date of delivery of the funds on the date on which the exchange of currency actually takes place is known as value date. Now remember, one is this transaction date on which I do the transaction, and second is the value date on which the actual transfer takes place. Okay, it's like the check. Suppose if I deposit the check today in your bank, okay, if the clearing is for one day, then it will be cleared same day. But if I get the clearing on your area is for the second day, then what happens? The value date of that check becomes second day. So that is the meant by transaction date and the settlement date. Okay. Forward rates are derived from spot rates and are the function of spot rates and forward premium or discount of the currency being quoted. So what is forward basically? Forward rate equals to spot plus or minus premium or discount. Means what? See here. One thing, let me ask you one question. All you guys who are watching on YouTube also, kindly answer me over here. If spot rate is given as 80.23 or 33, look at this. Everyone pay attention. If spot rate is given as 80.23 or 33, now who can tell me whether this currency is in premium or discount over here? Only based on the spot rate. Who can tell me whether the currency is in premium or it is in discount? Who can tell me? Everyone. 80.23/33. Now give me the answer whether this currency is in premium or it is in discount. Give me the answer, please. Yes. Correct answer, Sapna. The currency is in neither premium nor discount. Neither premium nor discount. Why? Because spot rates never ever decide the premium or discount. Never. Spot rates will never decide the premium or discount. Okay. Premium or discount will always be decided by the forward rates. 1 month, 2 months, these are called as forward rates. So premium or discount will always be decided by the forward rates only. It will never be decided by the spot rates. Okay. So you can't ever say that 80.2333 means the currency is in premium or discount. No. Okay. Now what is this bid or sell? See this. Bid means left side, buy, and sell means offer. Okay. So always remember, bid, offer, buy, sell. These two rates are always used by us. Now what is premium or discount? If the right side over here is bigger than the left side, means sell side is bigger than the buy side, then the currency is in premium. And if the buy side is bigger than the sell side, then the currency is in discount. Okay. Remember this basic. Okay. When the currency is called in premium or when it is called in discount. Okay. Now if I ask you the same problem over here, 80.23/33 and 1020 is given. Now give me the buy rate for after 1 month. So buy rate after 1 month will be what? 80.23 plus 10. Why? Because it's in premium. So my rate will be 80.33 over here. See this, 80.33, and here it will be This 80.33 plus 20. So it is 80.53. Okay. So whenever the currency is in premium, I have to add this. Whenever the currency is in discount, look at this 2 month, 30-20. So 30-20 means I will always discount it. Let it be buy or sell. So my rate will be 80.23 minus 30. So it is 79.93. Similarly, 80.33 minus 20. So it will be 80.13 over here. So everyone got this. Always remember, premium or discount is always decided from the forward rates. It is never decided from the spot rates. Okay. Chalo, move on. Now everyone, those who are watching on YouTube, okay. Firstly, I would tell you, subscribe to Officers Adda 24/7 YouTube channel. All those who are in the paid class also, subscribe to it right now. Why? Because on this channel, you get latest updates, number one, and all the marathons, all the free YouTube series, you get it over here for all the subjects of CAIIB. So join it immediately, click on the bell icon. Do it fast, okay? Now let's take this example. The following are the interest rates quoted in the foreign exchange market. Calculate the rates for the inward remittance and outward remittance values, spot, assuming the margin of 10 paise over the interbank rate. Now what is this? Now remember, whenever you solve any forex problem, okay, follow the 3 rules which I am telling you. Always follow these 3 rules. Number 1, decide whether it's buy or sell first. Oh, let me write it over here. Decide whether it's buy or sell first. Buy or sell. Okay. Second, decide whether it's premium or discount. Second, it's premium or discount. Okay. And third, decide the TT margins. TT or exchange margins. There are 2 types of margins. TT or exchange margins. Okay. So these are the 3 things you must always follow while solving any forex problem. Buy or sell means, buy or sell is always, suppose if it's an export transaction, then export will always be buy. Okay, will always be buy. And suppose if it's an import transaction, import will always be sell. Always. Okay, import will be sell. Remember this basic by heart. Okay. Premium or discount. Whenever the right side is big. Okay. In forward market, remember in this we are talking of forward only, not in spot. We are talking of forwards only. Forward. If in forward market the right side is big, then the currency is in premium. Okay. And if the left side is big, this is big, then we are talking of discount. Okay. Remember these basics in the numericals. We'll be solving one numerical right now. Okay. After this. So this is also one numerical, but this is the easiest one. We'll be solving a difficult one also. So premium, always in premium you have to plus, always in discount you have to minus. And TT margin, whenever you buy the currency, okay, you always subtract it. Whenever you sell it, you always plus the TT margins. These basics you should never ever forget in your life. Buy, sell, export is buy, import is sell. Premium, discount. If right side is bigger, then premium. If left side is bigger, then discount. Okay. TT margin, for buy you have to subtract, for sale you have to add. Remember this basic throughout your life. Okay. So let me come to the rates now. So the following are the interbank rates quoted. Those who are in the regular batch, you should be able to solve this immediately. Okay. So give me the answer for this. So those who are in the regular batch, calculate the rates of the inward remittance and the outward remittances. We have to calculate it for inward and outward both. Okay. Inward means what? Inward means money is coming in. Inward means what? Money comes in. Means what? Money comes in. Means it's a sort of export transaction. When does money come in? When goods go out. Goods go out means what? That is export. So here it's export transaction, means you'll have to buy. Inward remittance means buy. Always remember inward. Inward remittance is always buy because that is equal to exports. So now let's solve this. For solving this, let's use the simple basic rules which I have given. Okay, what is first? Let's calculate it for inward remittance only. Okay, inward. So let's calculate it for inward. Very easy problem. Very easy. Inward. Okay. What is in inward over here? 75.0050 and 75.0075. This is one rate. Okay. Now this is given as spot for you. Spot. So inward remittance means what? For inward it will be buy or sell. It is always buy. So first step is solved. First is one buy. So I have done this buy. Now second, premium or discount. So premium or discount means what? What will it be? There is no premium or discount over here. Why? Because the transaction is on the spot market. Suppose if there is a transaction in spot market, this second step does not come in. So this step is cancelled over here. In our problem, there is no second step. Okay? Because there is no forward market. A third step, TT margin. For buy it is minus and sell it is plus. But what am I doing? I am doing buy over here. So I'll use minus. So what is the rate I should use now? Buy means what? Left side is always buy. What did I tell you earlier? Left side is always buy and right side is always sell. So my rate which I'll be taking is 75.0050. This is my buy rate. Now what will I do in this? TT margin. What is TT margin given? TT margin given is 10 paise over the interbank rate. See this 10 paise. Now this TT margin will be given to you either in terms of percentage or in terms of directly paise. So here it's given directly in terms of paise. So what will I do? I'll just add this. Okay. 75.0050. This is my rate over here. So what should I take now? I should add it over here. So it will be what? It will be 10 paise. So plus 0.0010. Use it this way. Okay. Whatever is given to you will always start from the last. So this is buy. But what do I do in buy? Should I plus or minus? In buy I should minus. So plus is wrong over here. It should be minus. So what will be the rate over here? 75.0040. This will be my buy rate or inward remittance rate. Okay. One sec. Are you able to see it? Yeah. Yeah. So inward is 75.0040. Similarly, now for this outward is what? Outward means sell rate. So 75.0075. And what is the margin given? 10 paise. Again the same 10. So 0.0010. Okay. Now what do I do? In sale we should always plus. So my answer will be 75.0085. Okay. This is my answer for outward. And this is my answer for inward. Remember this. Okay. So all the three steps we need to always focus on, always check whether they are applicable or not. Okay. Next one. The spot GBP is quoted at 1.6 against USD and 3-month forward is quoted at 1.5. Then the GBP is at discount. The USD, the other currency is at premium against the GBP. Now what do you mean by this? See this. Understand how the currency rates are quoted. See here, whenever we say GBP to USD, how will we write the GBP here? GBP to USD is always the rate is indirect rate. See this. There are two types of rates. One is direct and second is indirect. Direct means what? Direct means always direct. Direct means what? Dollar to rupee. Whenever your dollar is in numerator, it's called as direct rate. Dollar in numerator, it's called as direct rate. And whenever indirect rate means what? Indirect means dollar will be in the denominator. So here it will be GBP. GBP we write it over here like this L. Okay, $2. Whenever dollar is in the denominator, we always consider it as an indirect rate. Now over here, GBP to USD. So the rate is what? In the spot, it's given as 1.6 upon 1. See this, you divide it over here. 1.6 is to 1. In spot. In forward, what it is given? Forward it's 1.5. So it is going down. 1.5 is to 1. So in spot it is 1.6, in forward it is 1.5. So always remember one basic rule. Whenever numerator reduces, numerator, okay, whenever numerator goes down, it means the currency is depreciating against dollar. The currency is depreciating against dollar. So your GBP is in the numerator, it is going from 1.6 to 1.5. So that's why this currency will depreciate. Okay. So then GBP is at discount. Discount means depreciate. And the other currency means dollar is at premium against GBP. So Indian rupees spot being quoted at 48.769, 7069. 6 months premium being quoted at 68.58. It means USD is getting quoted dearer in forward, is being quoted at 48.0211. Then the USD is at discount. Means understand the problem over here. The logic of this full new slide over here is whenever the numerator currency is going down, then it is called as depreciating and other currency appreciating. Whereas in rupee to dollar is always a direct rate. Dollar is in the numerator. We are in the denominator. Rupee is in the denominator. So what happens? If this denominator part, it is 70 over here and it is going to 68 over here. So denominator is reducing. Okay. It means what? Denominator is reducing. Rupees, this is, it is reducing. Means what is happening? Rupee is getting depreciated. So dollar is becoming stronger. So it means that USD being quoted is dearer in forward. Because why? Earlier I had to pay $47.70 rupees to buy $1. Now I have to pay 48 what is this? Quoted at 68. Okay, 68.58 means it's a discount currency. Okay, because it's in discount 68 to 58. So it's coming into discount. So what will I do? I'll subtract this 48.70 minus 68. Okay. So my rate becomes what? 48.02. See this 48.02. Okay. So what does it mean? Earlier I had to pay 48.70 in spot, and after 6 months I'll have to pay 48.02 rupees. So who is getting stronger? To buy $1, let's say I'm buying 1 kg of dal. Okay. Earlier I had to pay for that 1 kg 48.70. Now for that same dal I am paying 48.02. So what has happened? The value of that dal has depreciated. Okay, because I have to pay what? Lesser money now. So dal has come down. Similarly dollar. So dollar is at discount over here. Whenever the denominator currency, see this is denominator currency. Rupee is at the denominator. So whenever the denominator currency reduces, okay, the dollar becomes at discount, while the INR is at premium. USD is costlier for the future value, while Indian rupees is cheaper for the future value. Okay. So always remember whether the currency is in numerator or denominator. It depends everything on that. Okay. Chalo, next one. The forward premium and discount are generally based on the interest rate differentials between the two currencies. Now, what do you mean by interest rate differentials? Interest rate differential word over here means the rates by the central banks. Central banks means what? Here, let's say USD and India and INR. In USD, we have the central bank of US is called as what? Fed, Federal Reserve. Okay. And us, India, it is RBI. Okay. So the interest rates for Federal Reserve and interest rates for RBI decide whether the currency will go up or down in the near future. So always it depends on the central bank's rates. Okay. The demand and supply depends on the following factors: movement of capital in normal times as well as out of fear, fright or fear. So take one simple example. Because of that Russia-Ukraine war, what had happened? In the Russia-Ukraine war, everyone was afraid. If this Russia war goes on, then the gas prices will go up hugely. So that's why this was a fright point. Whenever we are in fear, then what happens? Capital tends to move towards the safer currencies. So because of that Russia-Ukraine war, everyone moved to dollars. because it was a safer currency. Status of export and import, that is trade balance, also balance of payment. So balance of trade will always decide whether this country is going up or down. If any country's exports are more, then that country is definitely going up in the longer run. Okay. Financial or fiscal status of the countries, that is freedom to invest or move in and move out of infra and labor position, means if any country is having free currency, like in India we have free currency, fully convertible in balance of trade. So if we have fully convertible in balance of trade, people will tend to do more business with us, because they know if I want the currency anytime, I want the payment anytime, then the government won't stop it. Okay. Chalo, next one. In a perfect market with no restrictions on finance and trade. Now, what is perfect market? Perfect market means here there is no government intervention. Everything is decided by demand and supply. Remember, perfect market means it is totally decided by demand and supply. Okay, in India we have a perfect market. Why? Because in India, government, RBI, FEDI, nobody intervenes in the forex rates directly. Okay, they never intervene in the rates directly. So that's why we have a perfect market over here. So in perfect market, the interest rate is a basic factor in arriving at the forward rate, right? Interest rate means the interest rate of the RBI or the Federal Reserve. Always remember, whenever you are dealing in BFM, you have to always be concerned about US also, because US dollar is the base currency of the world. Okay. The government control is a basic factor in arriving at a forward rate. Government control. Like in India, we don't have a government control. In China, they do have huge government control. US, no government control. Okay. The import and export are the basic factors arriving at a forward rate. So that is, we have discussed it already. Okay. If the rate of interest in US for 3 months, prime bank bill rates is 2% per annum, while the similar paper in London can be purchased at a rate of 4% per annum. Then, what do you mean by this? See, the rate of interest in US is 2%, while the rate of interest in London is 4%. Then what will happen? The rate is, people are getting more rate. It's like the FD over here. If in US I am getting the rate of FD as 2% and in London I am getting the rate of FD as 4%, where will you invest? You will invest in London basically, isn't it? So there will be flow of funds from USA to London to take advantage of the higher yields. Common logic, isn't it? It's that FD rate only. Okay. Now, if the rate of interest, say in US for 3 months, prime bank bill rates are 2%, while the same paper in London can be purchased at the rate of 4%, there will be a demand for USD in the forward market. Now, what is this? This one was very simple to understand. Very simple. Wherever I am having the higher FD rates, I'll go and invest it over there. It's that simple. But this is difficult. Why? Because the rate of interest in US for 3 months, 3 months means 3 months bill rate, 3 months T-bills, okay, is at 2%, while the same paper in London is at 4%. Then there will be demand for USD in forward market. Look at this, forward they are talking of, and here they are talking of spot. Always remember, that's why I said this is difficult, this was easy. Spot is always easy to handle. Forward is always difficult to handle. Why? Because what will happen, why this is in forward market, you will always get confused over here. You'll say, sir, if dollar, pound, I am getting higher rate of interest, then people will invest in pound. Why should there be a demand in dollar? It is in the forward market. Why? Look at this. The US investor will have to buy GBP by surrendering USD in the spot market, and GBP so obtained by him will be invested in UK bills. Now see here, if you have to invest in India, you have to invest in rupees. If you have to invest in USA, you will have to invest in dollars. If you have to invest in UK, means London, so you'll have to invest in pounds. So if the rate of interest in pounds is 4%, everyone will invest in pounds. But where are pounds? So everyone will buy pounds in the spot market. Okay. But this is for 3 months only. This FD is for 3 months. So after 3 months, whoever is the US investor will have to go back to his country. isn't it? So what will happen? This pound FD which he has made, he'll get the money in pounds only afterwards. So what will he do? He'll right now book the forward market. So what does it mean? See here, it means like this. Suppose if I'm investing over here today I'm investing, okay? I'm from, let's say, India, okay? I'm investing in pounds. So I'll sell rupees now, okay, and buy pounds today. Buy pounds, okay. This is buy pounds today. Now this I'm investing for 3 months FD, 3 months. So after 3 months, what will happen? After 3 months, I'll buy rupees because I have to go back to my country. I'll buy rupees and sell pounds. So this is known as the forward market. So that's why the reason given over here was there will be a demand for USD in forward market because the investor from US will have to go back to his country. Okay. Next one. Now this is one important numerical which we'll be solving today and then ending the session. Okay. Yeah, no, this much today, no, yaar. You have to see here. There are many things coming from your side. Students are saying, sir, stop, no stoppage. Only 2 weeks are there, and in 2 weeks also you have ABM and BFM combined. Saturday you are having ABM, Sunday you are having BFM. How will you study after in next week? Not at all. Okay, we'll complete this. Oh, there is new class. There now there. Which class? Okay, there is a BRBL class. Okay, then I'll stop. Tomorrow we'll continue with the same class. Okay, tomorrow we'll continue. Everyone, chalo, bye. Everyone will continue tomorrow. Those who are in YouTube, kindly join this PowerPack revision batches or video courses batches. Remember, okay, join these 2 batches, either of these or both, as per your wish. Because if you are not able to attend the regular sessions on time, you can attend the video courses batches. Okay, so you can join either of these. Both discounts are available. Mahapacks are also available. Join the Mahapacks also. We have started the batches for October also. November, December batch. We have started for that also. Join that. Use the code Y432. How to use it? Let me show you. Okay, go to Adda 24/7. Okay, let's go to Adda 24/7. Let me show you. Yeah. Okay, those who are in the paid class, you can leave now. Okay, we'll be stopping over here. Okay, chalo, I'll just do tell those on YouTube to join, how to join it, and then we'll stop. Okay, so click on JAIIB and CAIIB, then click on CAIIB 23. See here, this is for November batch. And this is for this month's batch, June. Okay, click on this. You'll see the batches. See this PowerPack revision batch. Click on this batch. You'll see the details. All the details will be shown. Means what are the days, timings, what is the study plan. Everything will be shown over here. Read it at your ease. Okay. Also, now let's look at the fees part. 3519. Click on more offers. Put the code Y432. Y432. Click on apply. Look at this. Now 15,999. There is 78% off. Everyone is getting. So join it immediately. 3519. It's such a huge discount you are getting. Similarly, in video courses also you are getting the discounts. Okay. Join them immediately. I would say PowerPack revision batch